All right, guys, thanks for joining today. I'm just going to discuss GameStop as basically a case study. The whole saga of a couple weeks ago is really interesting, and I don't think it's completely understood by a lot of people. So just would like to share my understanding of it. So GameStop itself is a public company. It was founded in 1984, IPO'd in 2002. It's a consumer electronics and video game retailer, of course, and that's cool. I didn't know that would happen. Good to know. And it's basically been in decline for several years, as people move everything online. You can buy video games online without having to go to a store, where before you'd have to go and buy an N64 at GameStop or something, or buy a used game. Now you can just download it on your Xbox or on your computer, or whatever you're using. So without delving too much into the financials of the company, you can just look at their top line, which has declined by about a third from 2016 to 2019. It's been pretty clear to a lot of people across the whole market that GameStop has been just in a steady decline, as part of the retail sector has been anyway. So before we get into the actual details of this specifically, there were a couple things that contributed to this being set up really to be the big explosion that it was. First of all, there's any kind of social media, and in this specific case, Reddit was a huge contributor. Anytime that you can tweet something or post something online, whether that's Reddit or Facebook or whatever, and thousands and even millions of people can see it and agree or disagree, that is a really strong way to create a herd mentality. And in a lot of different bubbles across history, there's that herd mentality that builds up, and it didn't always have the platform that it did today. It's very easy for people to come together and all agree on the same thing at the same time, much more than it has ever been in the past. On top of that, there's the democratization of trading. So specifically, Robinhood came out first and said, hey, we're going to do away with trading fees. It's completely free to trade on our platform. Now, they did find ways to make money by doing other types of fees. But as far as the trading fee that's published to you goes, where before you would have to go on and pay a $5 fee or $10 fee or $15 fee, whatever it was, they were the first ones to come out and say, we're not going to do fees. And that was a huge marketing, sorry, somebody's coming in. That was a huge marketing tool for them that allowed them to gain a lot of customers. And so it got to the point where basically you could go on any trading platform and it's all free now, which means that people who have $100 in their account can buy and sell things constantly without having to worry about, okay, if I make like 4 trades, I'm done, So it really also created the environment where people can day trade without the fear of costing themselves all the money that's in their account by trading fees. Also, COVID itself, like, people don't have as much to do, frankly. And so sitting at home with nothing to do, I guess I'll address that later, but sitting at home with nothing to do, there's trading as an option of entertainment. And so I post this picture of Davey Day Trader, which refers to, obviously, Barstool, which is just an example of how it's an entertainment focus rather than an investing focus. Is day trading for fun, day trading for profit, of course, but the fun is more important in that case and in the case of many others. So Chewy, where does Chewy come in? In September of 2020, Ryan Cohen, who was a co-founder of Chewy.com, came in to start his involvement with GameStop. So he bought up nearly a 13% stake, and he was basically saying, hey, I really want this company to succeed, but it's not going to succeed the way it is right now. If we transform it into an e-commerce company, something that people can go online and it'll be like, picture Blockbuster, but online. That's Netflix in some ways. Picture going to Petco, but it's online. That's Chewy. So he had a history of doing this, And so it spurred a lot of confidence, and it also was accepted by the company as, this is a good idea. This is something we probably should have been thinking of doing, but now we have somebody who will help guide us. So they gave him 3 board seats, which is a really big deal for somebody who just comes in as an investor, and they were very receptive to his suggestions. And then on the other side, you've got short sellers. So what is short selling? Well, that's basically the actual way that it works is, if I'm a short seller, I'm going out and I'm borrowing shares from somebody, and that's usually a big institution that lends shares. There's a whole branch of big financial institutions called securities lending. And it's basically, hey, I'll let you borrow my shares, and you have to just give them back to me at some period of time. Plus, you're going to pay me a little interest on them. And the person who's short selling says, okay, that's fine. I think this company is going to go down in value, so I'll borrow those shares. I'll sell them now. Let's say it's a $100 stock. I'll borrow $1 million of that stock. I'll sell it. I'll have $1 million cash. And at some point in the future, which I'll worry about later, I'll buy the stock back for less, and I'll give you back your stock that I've borrowed from you. Obviously, the goal is to buy it at a lower price, because then you can pocket the difference, and that's a profit. And this is the opposite of, if you buy a stock, you're expecting it to go up. If you expect a stock to go down and you short it, then you can make a profit on it, even if it goes down in value. So the obvious best case scenario is that the company goes bankrupt and you just don't have to repay anything. You've made all of the money that you've borrowed the stock for and sold it in the past. You do have to still pay that interest fee on it, but for the most part, you've basically made all the money that you can on that company, because it's gone to zero. Well, what's the downside? The downside is you buy it for 100 and it goes to $1,000 a share, and then you have to cover $900 a share difference. So on what was $1 million short, you could lose $9 million, or some huge amount. So in the case of GameStop, you'll see that it went from $4 to $20 to $40 to $400. So somebody that had shorted, and like, this is a legitimate number, somebody shorted like $1 billion of GameStop shares, they end up having to pay 10 times that. They're out $10 billion. Like, that's an insanely large number, but it's possible. And I think I'm pretty close on what those actual numbers were. So heading into late 2020, you've got the long side, which means people that were expecting GameStop to recover and to profit and to prosper in the future. So of course, you've got the company and the company's management. You've got Ryan Cohen, who's the Chewy co-founder, and then you've got various other institutions and traders, who were invested in GameStop, whether that was for indexing reasons or because they actually thought it was going to succeed or whatever. On the short side, you had various hedge funds, and that specifically throughout January became clear that one called Melvin Capital, another called Citron Research, who were very publicly scorned for being short and targeted by these investors on Reddit. They were on the side where they thought this company is going to go bankrupt or at least decline in value. So those were kind of the two sides heading into. Got a couple more people joining. Those are the two sides really heading into late 2020 and into January of 2020, where this all really occurred in mid to late January. So the initial idea coming from traders on Reddit was, we're going to squeeze the shorts. So what does that mean? If you think about a stock, and I think I've tried to indicate this in my talks previously, the stocks trade in a market, so it's like anything. And I give the example of, if I have a Beanie Baby and two people want that Beanie Baby, I'm going to have them bid against each other, and I'll give it to the highest bidder. Well, just think of that in the context of millions and millions of shares. If you've got somebody bidding for 100 shares for $20.75, and somebody comes in and says, I'll pay $20.76, then you're going to sell it to somebody who pays $20.76, and it goes up and up and up. So if many people come in and try to buy a stock, that's going to put the stock up. It's a supply and demand equation. It's very, very simple if you just look at it in that way. So what happens when you do that is that the short positions come under pressure. If I have a short position at $20 and I see the stock going up and up and up, well, I might want to close out and take my losses so that I'm not on the hook for more losses later. So that's the idea. You know, if somebody with a short position sees a whole bunch of buyers coming in and putting a lot of pressure on the stock, that can spook them, or they might actually be obligated to close out their position because, let's say, they've only got a maximum amount of money that they can spend. If they hit that limit, then they're at zero and they can't go anymore. So they have to close out the position. They have to buy the shares and fill the borrowed shares that they owe, or I mean, they have to, they're obligated to. So what happens at that point is that more demand comes into the market in the form of short sellers closing out their position. It's called a short squeeze. And you see it actually very frequently in heavily shorted stocks, where a lot of people come in, see the short position, buy stock with the hopes of causing a short squeeze. The stock spurts up, and then it's just usually just a quick spike because it's just a very short-lived supply and demand imbalance. So that was the initial idea. What basically ended up happening was this guy, who I actually don't remember his name, but he's the Citron research guy. He came out and had this live stream, and the traders on Reddit, Wall Street Bets, went absolutely nuts because here's this big hedge fund guy basically saying, oh, you're all so dumb. Like, I mean, he didn't actually say this, but he's like, look, you know, here's how the market works. I know what's going on here. It's just momentary, whatever. And what everybody on Reddit heard, and from many, many comments that I read, everybody's thinking this guy's such an asshole. He's coming out and saying, I'm smarter than you guys because I have all this money and I run a hedge fund and blah, blah, blah. So screw you. And so they all just said, we're all going to buy this to the moon. And there's all the rocket ships. And so what happened was this ended up, instead of just being a short squeeze, it became this gigantic movement, this big protest against not just this guy, who was kind of like the banner man, but, you know, against Wall Street, against institutions and wealth and everything. Like, oh yeah, it's all, you know, they hate the little guy. Let's all go get him. And so here's what happens is you get all these people banding together. I just took like a little snippet from, I think it was like the 26th of January, but like, this is all the kind of stuff that these people are saying. And there's tens of thousands of posts of this stuff. You know, the rocket ship emoji became this huge, hugely used little thing where it's like, to the moon, we're going to just ride this thing till it hits 1,000, till it hits 1,000,000, whatever, without really any regard to what the company is actually worth. And then Elon Musk even pumped it up by coming out and tweeting GameStop, and a lot of people just like were fired up by that. But it's all these people egging each other on, and, oh, we're going to make this stock go up. We're going to screw these guys over who have all this money invested in the short position. And then what happens is that short squeezes don't last forever. So I could have done this talk in late January, but I did want to see it play out so that I would have something to refer to. It was quite predictable that this was going to happen, just because what happens is you get that short squeeze, and more people were piling on. And what happened was it drove the price way up, like way beyond anybody's expectations, which was to $400, nearly $500. And then all of a sudden, there aren't more people to come in and buy the stock at that price. So people who have bought it at a certain price say, all right, well, I mean, the stock's not going up anymore. I'm going to sell it at this point. And it's kind of drifted back down, of course. And it is way above where it was before, because there's a lot more interest and investors in the stock, or traders, investors, traders, whatever you want to say. There are more people in the stock, more people following the stock and the company itself. And I think in some cases, there is that conviction that the company actually is going to profitably move forward with a new business plan, which is possible, but it's certainly not worth a $400, $500 valuation. It's like almost impossible to justify that from any kind of reasonable argument. So this is very typical. This is a very typical short squeeze, if you want to call it a bubble, whatever. So this was entirely expected, and very interesting, because I'm very curious to look into this further, and I think it would make a great sort of like PhD thesis to really dig in, because there are so many different interesting angles to this. both from the actual trading side, but also from like a social side and a socioeconomic kind of perspective. Like there's so much that you could dig into here, and I'll touch on a few other points in a little bit. So yeah, there's just a lot. So there were also other companies that benefited from this kind of trading frenzy. So AMC, BlackBerry, Bed Bath and Beyond, and several others. They all had big short interest positions. So like GameStop was the banner stock that everybody's piling into, because the short interest was actually over 100%. So like that just meant that more people would have to close out their short positions as the stock ran up. So like the actual idea of a short squeeze was sound, but the idea that you would squeeze these people, they lose all the money, and then everybody else would end up with all the money was kind of inaccurate, because somebody's going to end up buying at that high price and losing the money as the stock comes back down. So like some people did lose money in this trade, and it's unfortunate to see that, but it definitely happened. But yeah, so these other companies were also highly shorted. I think probably closer to like 50-60%, which is a very highly shorted name. Typically, I think you'll see short interest will be far under 10% in any given company. Like Tesla was an example that was shorted for a very long time, and I think it's less shorted now because a lot of the short positions just lost a lot of money, because it just kept going up and up and up as a cult stock, and it still is. But so these were referred to as the meme stocks, which shows that, I mean, you could even see it if you went on the forums and read some of the stuff. Like a lot of people were very conscious that this was just kind of a screwing around kind of exercise. And I mean, you can read the comments yourself. So why did they actually fall? These companies were highly shorted for a reason. These have been struggling companies. So at a certain point when, and I already kind of touched on this, but at a certain point when there were no more buyers than there were sellers, well, that's when you get the peak. And without the fundamentals to back it up, there are just not going to be any more buyers at a certain point. There aren't enough people to come in and support the stock at that level. So that's why it dropped back down. Again, supply and demand is a very simple way to look at it. Another really interesting angle of all of this is that Robinhood, on the 28th of January, I believe I think it was like the Thursday, or might have even been the Wednesday of that week. It seems like it was just a whirlwind week where really all of this trading happened. I mean, billions and billions of dollars. I remember it was like 10 billion one day and 20 billion the next day. And the market cap of the stock was only like 5 billion 2 days before that. So it was like a huge amount of volume going on. And Robinhood actually couldn't support all of that volume, because what happens is they're not booking all of these trades. I mean, the trades have to be actually processed somewhere. And so they're working with companies who have said, we'll process these trades, but you have to have a certain amount of money in your account, so that if for super volatile, this is very unusual, but for super volatile names like GameStop or AMC or BlackBerry or whatever, if somebody goes in and buys puts and calls at $20, and 3 minutes later the stock's at $25, somebody's on the hook for that, and we need to be sure that the money's in the account so that one person gets paid and it gets deducted from somewhere else, so we're not on the hook. So you guys need to put more money in your accounts, basically, so that we can continue to execute trades for you. But so what they did was they basically said, all right, everybody on our platform can't buy shares anymore in these names until they put more money in their account. But they didn't really say that. They just said, all right, there's no more trading in these names. And it created this giant rage at Robinhood, who had been kind of like the app of the people to date. It was like, oh, you guys are in the pockets of the hedge funds and like Wall Street, whatever. It was very interesting to see the backlash against the company that had been just like hours ago had been so trumpeted as like a platform for the people, and then the flip of the switch, because they literally could not, but it wasn't well explained. And as a result, there was a huge backlash against the company. And I think it will probably going forward affect them as a business. Who knows by how much, but I think it put a lot of a bad taste in a lot of people's mouths, and anybody who lost money on that trade is going to just be like, oh, it's the fault of Robinhood. It's not my fault for buying stock at $300 a share. Obviously not your fault for doing that. Maybe. So then in the aftermath, there are very interesting potential ramifications. Janet Yellen, who has been calling meetings and calling people like from Robinhood, and will probably call a couple people on the Reddit forum in front of Congress to actually testify on this whole thing. And I know that the SEC is like combing through all of the posts that were on Wall Street Bets, because in some cases they could charge people for market manipulation. If you go out and buy 1,000 shares of GameStop and then go on a forum and say like, this stock's going way up, like I promise you, I'm positive, whatever, like there are certain things that you just can't say, and that's part of market regulation, like making sure that nobody's manipulating the price of a stock by encouraging others to buy it or by buying more of it themselves. And then actually kind of in that same vein, like targeting short sellers in some ways would be market manipulation. Like if I was a billionaire hedge fund manager and I went out and bought billions of stock in a company because I knew it had a short position, and the whole idea was that it would drive the price of the stock up, and then they would have to buy back that stock from me at a higher price, that's market manipulation, and I could go to jail for that, or at least have like massive fines if I settled, which would be probably like a best case scenario. But so, that there are a lot of issues that it's hard to address when it's a distributed effort, because it's very easy to address when it's one person who's got all the money and is making that move. But when it's millions of people buying into a stock in order to make the market move, and maybe not everybody even knows that, like, how do you regulate that? It's a really complicated issue, and I'm not really sure what the answer to that is. Like, do you regulate it? Do you just let these kind of things happen and assume that people will learn their lesson and it won't happen again? I mean, history has shown that this does tend to happen every so often, where people don't learn their lesson, or they did and they forgot, or I don't know what it is, but like these kind of things just happen. And personally, I don't really think there's a way that you can regulate it. I don't think that you should try to regulate it. It's just kind of how the market works. Like, what are you going to do? You're going to regulate message boards? You can't really do that. Freedom of speech is an issue there. Are you going to prohibit short selling? It's possible. There's a lot of hatred towards short sellers because people think that they're trying to ruin companies, which is not necessarily true. I think there's a place for short selling, and in a lot of cases, short sellers have been the ones to point out things like fraud. So there is a place in keeping an efficient market for short sellers. And then you can't really restrict trading for people who are just retail traders, because that would actually go against the whole idea of keeping an open and democratic economy. If you shut out people who are creating volatility, well, you're shutting out the little guys, and that's not really fair. So I don't know if there's really any way to regulate it. And it kind of brought up this whole issue with a big debate, and a lot of people were piling on Reddit, is the system rigged? Like, especially with the whole Robinhood stopping people from trading, that was the whole narrative, is the system's rigged. They back channel talk to the people at Robinhood, and they're like, oh, we've got all this money invested, like, can you shut it down, whatever. There's a lot of concern that, and I think it's kind of how capitalism functions in general. Like, if you have capital, you can just make money off of that capital. So I think there's a lot of discontent just around the way that system has created greater wealth disparities. And it brings up a really interesting discussion, and I think that it's good that it is being discussed. Somebody talked to me yesterday about a SPAC. So this is just a totally separate subject, but I wanted to address it quickly. So a SPAC is short for special purpose acquisition company, also known as a blank check company. So what is it? It's basically anybody can do it, and you're seeing a lot of celebrities and big names going out and raising their own SPACs now. Like, I think the latest one was like Colin Kaepernick, and one of the part owners of the Phoenix Suns are going out and raising a SPAC. I know Alex Rodriguez went and raised one, Shaq raised one. Like all of these big names are going out because you can go out and be like, hey, this is my name, I'm going to raise a SPAC. How cool is that? And people are like, oh yeah, I'm totally down. I'll totally invest in your company. And they can raise hundreds of millions of dollars. But what is it? Like all it is it's a commitment on their end that they're going to buy something, and it's specific to a certain period of time. So very commonly 18 months or 24 months, they say we're going to use this money to buy a company in the next 18 to 24 months. If we don't, we'll return your money to you, the investors. But the problem is if they return their money to you, then they don't make money. So it kind of creates a conflict of interest. If you tell somebody you can make all this money and all you have to do is X, then they're going to do that, especially if all it is they have to buy something else in 18 to 24 months. It's kind of a ridiculous expectation, and it basically encourages a lack of due diligence. So as an example, one SPAC that recently ran into some legal trouble is Clover Health Investments. They're being investigated by the Department of Justice, but they were being investigated before they were acquired by a SPAC. And the issue is that they didn't disclose that. The whole purpose of companies wanting to be acquired by a SPAC is that either one, they're getting a better price than they could get otherwise. Two, there are way fewer legal hurdles to getting becoming publicly listed, which, let's say you're an owner of a company and you want to start selling off shares because you want to monetize it. Like, for example, let's look at WeWork. Like WeWork was going to IPO, but they ran into a lot of issues and didn't have the backing to go through an IPO. So they're exploring ways to go public through a SPAC now because the owners still want to sell that stock. They don't want to just be sitting there with their position in WeWork, because the idea was that they'd go in at a certain price and sell it at a higher price. Anyway, also another issue with SPAC is just the structure of how they get paid. So if you're the sponsor of a SPAC, so like in the case of like a Shaq SPAC, Shaq is the sponsor, or A-Rod is the sponsor of his SPAC. The SPACs typically IPO at $10, and they can get shares, like millions and millions of shares, for like $1.50 or $2 or $1, like a very low price. So that dilutes other shareholders that come in, and it's a great deal for anybody who's raising a SPAC. So like, I don't know, it's a kind of a no-brainer unless you have a conscience. But and then as far as investing in a SPAC, you're investing in somebody else's expertise in buying a company that's at a good price. And like most of the people that are raising SPACs right now don't have that expertise. It's just kind of a concept, like, oh, it sounds great. So I give this example to somebody else, but like, you could go out and buy shares of McDonald's. You know what McDonald's is, you know what you're going to get. Or you could buy this shiny box with a question mark on it, which is what a SPAC is. And it's going to be so great, but maybe who the hell knows? And for whatever reason, the market's really frothy right now. And all you have to do is say, like, I'm buying something green or electric vehicles or like Bitcoin, any of those like really sexy words. And like the price of your SPAC is going to go up like double, triple, whatever. It's ridiculous, but it is what it is. And it's made a lot of people a lot of money. And that's, you know where I stand on it, but that's what a SPAC is. So let me just see. I think I had a couple things in the chat that I just want to check real quick. So Rich goes, agree with herd mentality, but when the first guy posted his position on GME, he was crucified. Yeah, I'm sure he was. And I think a lot of the original investors were actually in it for reasons that they thought it was a legitimate good investment. And Wall Street Bets, I think, started out that way. I know you've been sending me like little blurbs from Wall Street Bets for many months, but it started out as a community of people who were interested in just discussing positions that they're taking in the market with other Joe Schmoes, you know. But it snowballed into this gigantic movement and gigantic massive people spamming these messages. So it's not, Wall Street Bets is not what it was originally intended to be. It's a completely different animal. But yeah, it's interesting, you know. That's just how some things happen. Messy flow. How can there be a short position with a higher percentage than there are shares in existence? So basically think of it like I borrow shares from a bank. I resell those shares. Somebody else sells those shares again. That original bank buys those same shares. They wouldn't know that those are the same shares that they lent in the first place. So if they then go lend those same shares a second time, then that share would be double lent, you know, because it's not like this is share number 1, 2, 3, 4, 5. You know, this is just a share. It doesn't have any. It's not like a Bitcoin, like or something in crypto land where it has like a code and ID on it. You know, it's just a share. So you can in this case, I think there were so many shares in that company lent multiple times that I think there was like 130% short interest at one period, which is a huge amount. And it's probable that it was just the flow of shares in the market. You know, somebody lends the shares, somebody the borrower sells those shares, and then they're sold back to the original lender. So that it happens. So SPAC, give me a bunch of money and I'll buy something. I swear, if I don't, I'll give you back the money. Yeah, that's how it works. And also it's like, if I buy something, I get rewarded in the form of shares. So it's a very weird structure. I think it has some serious issues. If I'm relying on someone's expertise to buy something, I don't want a pro athlete. I want a pro investor. Yeah, I mean, I obviously would feel the same way, but I think that a lot of people just hear it as I don't think a lot of people know what a SPAC is, and it's just one of those words that like is an ETF. People are like, oh, I want an ETF, I want a SPAC. They go up, whatever, and then they go and they buy them, and without really knowing what it is. I mean, I've talked to a lot of people who are like, look at these letters that are in my portfolio, and they don't really know what those letters mean, except that they're, you know, they stand for this company's name. You know, it's just kind of what happens every now and then in a very frothy market, which is what's going on right now. Is there a distinct line between what constitutes public sharing of position, enthusiasm for a company or product, or market manipulation? So it's sort of a gray area, and that's kind of the case with most stuff related to the SEC. Is it's mostly gray area. There's some guidance where, like, say I was running a hedge fund and I had this huge position in a company. If I went out and talked about how great that company was and didn't disclose that I own a position in it, that would be probably interpreted as market manipulation. But if I went out and said, I own a position in Google, I love Google, it's so great, I do all my searches on it, everybody I know searches, like, as long as I disclose that I have a position, that kind of makes it okay to then say whatever you're going to say, as long as it's like true. If you're like, Google owns the moon, then, like, I mean, that's another issue. I think I don't think you can say shit like that. But for the double owned short positions, if both people who borrowed shares go to close their positions, they would just be bidding for they would be basically trying to outbid each other in the market, which is like, it was just like a crazy short squeeze, you know, because so many people were trying to close out their short positions that they ended up kind of bidding against each other, probably not, you know, because it's all digital. Like, you're not going into a marketplace and saying like, hey, I need to close out my short position, I'll buy 100 shares. And then the other guy goes, excuse me, I'm trying to close out my short position, I'll buy those 100 shares for a penny more. It's like, that's basically what happens digitally. but it's also not one to one, like it's going to generally push the price of the stock up. But there's also people who are buying for their own accounts. That creates another, it creates another bidder, basically. It just adds to the demand for the stock. So Bill Ackman with Neutralite, or whatever it was, Herbalife. Uh, Neutralite, is that's the thing you drink when you're hungover or something? I don't know. Didn't you have a huge position? I forget if it was long or short, and then go on TV and make a huge doomsday prediction. Is that not manipulation? I believe you cleaned up. Yeah. Yeah, Pedialyte. Yeah, whatever. We're both wrong. So yeah, he took a huge short position in Herbalife, and his so it's not market manipulation, right? He went out, his first thing he said is, I have a huge short position in, here is why I have that short position. So that's not market manipulation, that's him saying that why he has this short position. And a lot of people who take short positions now are probably not going to go out and do that, because somebody will be like, oh, you got a short position, I'm just going to bet against you. So like in the case of Herbalife, that's a really great example of, he came out, he said, I have a short position, blah, 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 all these stuff. Basically, the thesis was he thinks it's a pyramid scheme, which will then be ruled as an illegally functioning company by the US government, and it will get shut down and go bankrupt. That was his thesis. And there was a lot of evidence to back it up, frankly. And then, wow, why am I blanking on the other guy that came in? Do you remember the other guy that came in? I can't remember his name, but I can picture his face. He's bald and he has a gray beard. Anyway, this other big hedge fund guy came in and said, all right, I'm long $1 billion on this company because I think it's a great company. But I mean, it seems pretty likely that he was just doing it to spite Bill Ackman, because they had kind of an internal feud. There's actually a great podcast. I think it was an episode of The Journal where they discussed the actual. I mean, I watched a really great documentary about this whole issue, actually, which was basically, I don't know if it was sponsored by Ackman, but it painted him in a white knight kind. Yeah, Carl Icahn. Thank you so much. So it painted Ackman in this really positive light and basically made the case that Herbalife is a pyramid scheme. And then Carl Icahn came in and was basically like, no, it's a great company and I'm buying it. And then it just created this whole very public battle between a short position and a long position. And what ended up happening was Carl Icahn won basically because the US government did not rule that it was a pyramid scheme. It was very vague. They were like, yeah, it's like, smells like a pyramid scheme, but there was no reason why they didn't. It's a very vague and frankly confusing ruling that they had, because they basically came out and were like, it looks like a pyramid scheme and smells like a pyramid scheme, but it's cool, we're going to let it keep going on. And so because of that, Ackman lost lots and lots of money, probably like, I don't know, $1 billion or something, I don't know. And then Icahn made a bunch of money. So it's just kind of what happens. He came in with this thesis and it was very dependent on the government shutting it down, and that didn't happen. So it's a really interesting case study on short selling. There's also another one. I think it was Valiant Pharmaceuticals, and I can't remember the name of the woman who ran a hedge fund, but very, very interesting story where she did tons and tons of research. And basically Valiant was going in, buying up smaller drugs and jacking up the prices a ton, which was like, these were life-saving drugs that were only available to only needed by a very small population. And it created a lot of distress for a lot of people. So she did the work, and as a short seller, she took a short position and came out and was like, here's the story. They're doing X, Y, and Z. And it crushed the price of the stock. And, it's so there are plenty of examples of short sellers who come out and publish information that they've done a lot of research on, and it helps debunk a very popular company. Like Wirecard was one that a lot of people went short and came out and published all sorts of different research pieces on, this is a fraud, they're missing X, Y, and Z money. And I tend to be pretty neutral on a lot of stuff, but I think there's definitely a place for short sellers. And it is, I don't see them as inherently evil, as is kind of popularly, it's a popular position to just be like, all right, short selling's evil, which is not true. These people aren't going out and trying to find like your local bakery and put it under. These people are trying to uncover fraud and bad business practices and say, this is not a properly functioning business. It should not be worth what it's worth. So that's basically it. Thanks very much, everybody. If you have any other questions, let me know. And I hope this was interesting little chat. Ended up being about 40 minutes, plus or minus. Yeah, people do see them as trying to sabotage business, which is not usually true, or I'm sure it is in some cases, but not usually, because that too would be market manipulation if they're just trying to sabotage business. So thanks, Case. Thanks, Rich. Thanks, Charlotte, Connor, Marnie, Annie, Nadia. It's good to see you guys. And I'll host another one of these soon. Hope this was informative.
Always is, man. Thank you. Take it easy, buddy.
Thanks, Adam.
Thank you. Thanks, Elliot.
Thanks, guys.